Hey, David Krasinski here from DK Home Loans, and today I want to talk about something that's going to affect consumers and their interest rates going forward. The agencies Fannie Mae and Freddie Mac have now instituted new loan level pricing adjustments that will actually impact a consumer's interest rate and or upfront cost depending on how much money they're putting down, what their credit score is, their debt to income ratio, the property type that they're buying, all kind of different things that impact a loan typically, but they're going to have a different impact now based on the new loan level pricing adjustments that are effective May 1st, 2023. Now, you're probably saying, Dave, what is a loan level pricing adjustment? We're going to get to that, but basically a loan level pricing adjustment is anything that's associated with risk that they back test these loans for that has an adverse impact on a mortgage-backed security pool. And what that means is if you're a consumer, and let's say hypothetically your loan is closing on April 1st, 2023, that means that Fannie Mae's not going to have that loan right away because it takes sometimes a couple days, a couple weeks for whoever closes your loan to then sell your loan to the servicer. Then the servicer basically sells the loan into a mortgage-backed security pool, and Fannie Mae and Freddie Mac purchase those loans, and then that's when they'll securitize that loan and sell it on the secondary market. So this could mean that your loan could be impacted as early as April or even sooner depending on who your lender is. Now let's get right into it. I'm going to kind of take you to my screen here. Loan level pricing adjustment are LLPAs. You'll probably hear those used together. LLPAs are based on your FICO score, debt to income ratio, occupancy status, whether that's a primary residence, second home, or investment property. Second home and investment properties have bigger adjustments than primary residence do, and down payment amount. This is enforced by Fannie and Freddie, the two major entities that guarantee a vast majority of new mortgages. What lender does this apply to? Any loan that's guaranteed by one of the agents regardless of the lender. So basically what that means is that there's a lot of lenders out there that almost 90% of them deliver loans to Fannie and Freddie. If a portfolio loan, then they're not going to Fannie or Freddie, but all the big lenders, Wells Fargo, Chase, Bank of America, Rocket Mortgage, UWM, United Wholesale Mortgage, they're all delivering their loans to Fannie and Freddie. So this is almost a universal loan level pricing adjustment that's going to apply. Examples of loans that would not be affected are FHA and VA, as well as any jumbo or non-conforming or specialty loan products like a non-qualified mortgage, where that's like where a property might have too much occupancy of investor concentration for a condo complex, or a bank statement loan, or something, a debt service coverage ratio loan that is not a qualified mortgage. Non-conforming loans are not impacted by this as they are not guaranteed by Fannie or Freddie. A common example of a non-conforming loan would be a jumbo loan. And basically what that means is anything right now in Maricopa County that is above $726,200. So if your loan was for $1 million, that is a non-conforming loan. Now, this is what I want to show you real quick, and this is where it gets very confusing for people. As if you look at this chart, you're thinking, oh my God, Dave, what does this mean? Well, green means good, red means bad. So the darker the shade of red, the worse it gets. And so if we kind of take a look right here, this is kind of the center of the worsening, and this is the example that I'm going to show you today. And so a loan level pricing adjustment is not bump in interest rate. So people, when you look at that chart, they'll think, oh, it's a bump, it's a 0.25% increase in interest rate. Well, that's not what it is. Think of it this way. If you're buying a home, your loan amount is $400,000. When you see a 1% increase or a 1% loan level pricing adjustment, that means $4,000 in upfront cost to get the same rate that you would have if you didn't have a loan level pricing adjustment. Same thing with a $100,000 loan. If you have a $1,000 extra cost or a 1% loan level pricing adjustment, that means that it's like having an additional $1,000 in upfront closing costs. Now, you can translate that into interest rate, which is what we're going to do here to show you what the translation is typically. Usually it's about a 1% increase for a 1/4% decrease in rate in cost and upfront fees. Now, so I'm going to clarify that a little bit more for you, but I want to take you back to this chart here and show you. So if we look in this area, this is all getting better for the consumer. So you can see like a lot of these lower credit scores, they back tested these loans, and so they realized, hey, these loans are performing better than we thought, so we're going to actually give these consumers a break, give them a little bit better of an interest rate. These loans are probably performing worse than they thought, so they're going to actually make these rates worse. And before, it used to be that if you had a 740 or greater FICO score, you didn't have to worry about any of these adjustments. Now you've got to have a greater than 780. And this is a mortgage credit report, not what you're seeing on Credit Karma. There's two different things here. Credit Karma is a Vantage Score 3.0. FICO scores from a mortgage company are going to be different than what you're seeing on Credit Karma here. So just keep that in mind as well. But this is kind of the area that's being the most impacted. And if we look, 0.75 is the worst adjustment. If you could look here where it's a 30% or lower loan to value, hardly any of these are being impacted. These are actually being impacted for a positive. 30 to 60, no impact there. 60 to 70, you're getting a little bit of an impact right there. 75, not so much. A little bump here, a little worsening here, just a little worsening here, better here than what we have now, and so on and so forth. So let's just get right into it. Let's show you what it's going to look like from a standpoint. And this scenario that we're going to look at, it is basically showing you, this is pricing based off of a $500,000 sales price, a loan amount of $405,000. Obviously, it's a conventional loan because only conventional loans can be sold to Fannie or Freddie. Maricopa County, primary residence, single family residence, 1 unit. We're using a FICO score of 720 here with a debt to income ratio under 40%. And we're using borrower paid monthly mortgage insurance with one borrower. This pricing is effective 2/15/2023, so February 15th. And the lock period that I ran through was locking through 3/31 for the scenario on the left, which is an interest rate of 6.974. And then I'm basically just running the lock scenario through 4/3 to show you what the difference in rate is. So you can see right here, the old adjustment is 0.5 for that FICO score at an 81% loan to value. The new adjustment is 1.25, so it's 75 basis points worse based on that chart that we showed you before. And what that's doing to your interest rate is it's bumping it up about 0.5% here. So you can see that 0.75 is significantly worse for a consumer. And one of the things that we want to talk about real quick here is some of these interest rates that we're seeing on the higher end right now. So let's say a normal rate is 6.75. Some of these interest rates that are higher in the sevens, or that they don't believe that these loans are going to be around, so they're not paying a big premium for these higher interest rate loans because the life of a loan, basically the loan gets sold, and so people want to pay a lot of money for those loans that typically have higher rates, but everyone thinks that rates are going to go down, so therefore they think, hey, let's not pay a huge premium. That's why you're seeing such a huge increase from 6.9 to 7.5 for that extra loan level pricing adjustment that's being applied with this market right now. I hope that you found this helpful and useful. I'm going to show you real quick here one more time the interest rate 7.5 versus 6.9. And if we go back to that chart take a look at that real quick. Here we are at the 720 FICO score, the 0.75 worsening for the new loan level pricing adjustments. Just wanted to say real quick as well, if you have any questions on this, you want to reach out to us for further clarification, we're happy to help you. Thank you so much for watching this video and have a great day.